Hello, and welcome back to Principles of Accounting 1. I'm your host, Dr. B. Today we are going to be talking about adjusting entries. We are currently in the second week of an 8-week course. What? Oh my goodness, what does that mean? We're almost 25% complete with the course at the end of this week. If you could believe that, it's a lot. There's a lot of stuff to do in an 8-week course. This is the condensed format of a course where it's 8 weeks long. We have 14 chapters to cover. What that means is we cover about 2 chapters per week. Today we're going to cover chapters 3 and 4. Chapter 3 has to do with adjusting entries. There are 2 assignments due this coming Sunday night. The first is chapter 3 quiz. The second is the chapter 4 discussion board. Discussion boards hold the same amount of weight, 5% of your total grade. Do not, and I repeat, do not skip anything in this course. The only way you'll fail this course ever is if you don't do the work. If you don't do the work, you will fail this course. So what that means is I want you to make sure that you're always completing all of your homework assignments, including discussion boards. Discussion boards are mandatory. So what that means is you must participate with full paragraphs, citations, and references, the whole works. Please, I don't want to see any one-sentence responses. I don't want to see a word response. That will not make me happy. They need to be full paragraph responses, okay? 1, original response to the discussion board, and 2, responses to 2 of your classmates. So that means 3 total posts for the discussion forum. Question?
Very quick.
Tyler.
Yes, in regards to the discussion format, in terms of citation and references, are those supposed to be like language formatted, or do you just mean like general references to where we
Just
go?
general, just general.
Okay,
Yep, yeah.
okay.
I'm not. This isn't an English class, so I'm not looking for APA style citation and references.
All right,
I just want you to identify where you learned the information from.
all right, that's fine.
Yep, cool, great question. Thank you so much. Okay, and I'll send out another announcement on that topic as well. But I do appreciate it. Okay, so for those of you following along, we are in week 2. So in the Classroom homepage, scroll down to Module 1, open Module 1, select week 2, download Chapter 3 PowerPoint, Chapter 4 PowerPoint. That's what we're going to cover today. And let's jump into it. So we are talking about adjusting entries. The idea of an adjusting entry is that we are making a correction to represent one of 2 things. We are representing the consumption of a prepaid expense or recognition of unearned revenue. Or we're making a correction to an error that we made. These are the reasons why we make adjusting entries. Adjusting entries happen toward the end of the accounting cycle. What that means is after we have prepared the financial statements for the month, or for the accounting period, we go through this process of adjusting entries. Okay, so at the end of the month, we recognize that a couple of things have happened. After we made our regular journal entries throughout the month, at the very end of the month, we make this thing called adjusting entries. And the adjusting entries represent an adjustment to an account like unearned revenue or prepaid account to represent the consumption or the recognition of that transaction. And we'll roll through a couple of examples, but it's a part of the accounting cycle. The accounting cycle, as you recall, we analyze the transaction, we make the journal entries, we go through, and this is kind of the way to think about this is like the third step of the accounting equation, is the adjusting entries. And then after the adjusting entries, we go through the closing process, and I'll explain all of that when we get closer. An accounting period. We had discussed this a little bit before. We recognize an accounting period as a period of time. Okay. A period of time could be a year. Semi-annual means half a year, 6 months, 6 months. A year, full 12 months. Semi-annual, the first half of the year, second half of the year. Semi-annual, 6 months and 6 months. It could be a quarter. A quarter is every 3 months. 3 months, 3 months, 3 months, 3 months, 4 quarters in a year. Or a month. In practice, at the end of each month, we make adjusting entries for that month to represent things like the consumption of prepaid insurance, to represent the application of unearned revenue, so forth and so on. Those are just a few examples. We do that every month. The things that we would do on a quarter is we would prepare financial statements to show us the revenue and expenses for 3 months. Or we might run the statement of cash flows or the balance sheet to show us the balance at the end of that quarter. Semi-annual reports, very similar. We would run half a year's worth of revenue and expenses to make sure that we're on target with our budget. We compare our actual performance to our budgeted estimations. And we might also look at the balance sheet statement of cash flows to understand where we are at the half year mark, to make sure that we're on track to meet our goals. And the annual data we look at is the entire year's worth of revenues and expenses, the ending balances on our balance sheet, and our statement of cash flows to see how we utilize cash throughout the year. That information helps us to budget for the next year. Those are just some examples of what we use that information for. We had discussed this a little bit in the previous chapters. There are two types of, or not two types, but there are two ways to go about accounting. Okay, there's what we call the accrual-based accounting and the cash-based accounting. There's a couple of key differences I want you to understand between the two. Cash-based accounting is commonly used in service businesses. For example, a restaurant would use a cash-based accounting system. That is where they recognize and record revenue when cash is received from the customer. Okay, and we also recognize and record expenses when cash is paid for those expenses. For example, in a restaurant, a customer comes in, they get their food and they leave. I record the sale of the food at the point that they give me the cash, right? That they pay for the meal. That's cash coming in. I record the revenue at that time. Not later, not at the end of the month, I record it when it's received. And expenses, I record those at the time they're paid, not when they're incurred. So the difference here is, let's say the restaurant receives the electric bill. The electric bill, I received it. It was for last month, but I'm paying it now. I record it for this month. Okay. That is cash-based accounting. I'm recognizing it when I receive and record the expense when I pay it. Yeah. So I receive the electric bill. I write a check for it. I put it in the mail. I record that electric bill when I paid it. Yeah. That's cash-based accounting. It is not the most accurate. It represents the cash flow, really. That's why they call it cash-based accounting. Okay, very straightforward. Easy. It's the easiest one to do. Go ahead, Mark.
I do apologize.
That's okay.
So basically, what you're saying is when money comes into your account, and you pay your rent or your mortgage. That's cash-based accounting, correct?
Yeah, that's cash-based accounting,
Okay.
exactly. So,
Okay.
so, so you receive the bill, you pay the bill. That's cash-based accounting. Very, very straightforward. Uh,
Okay.
and the difference between the two, Mark, though, is with cash-based accounting, we're recognizing the expense when we're paying it. So if I'm paying it now, I'm recording it in this month, not next month. If I receive the bill tomorrow, I record the bill tomorrow and I pay the bill uh, tomorrow. I recognize it in this month. Well, no, tomorrow's the first. So if I receive the bill tomorrow and I pay the bill tomorrow, I record it for March, not. I'm sorry, what month are we in? I record it for September, not for August.
I got you now.
So it's when it's paid. That's when when cash is paid. Now let's look at accrual on the left side of the screen. Accrual based accounting. Accrual based accounting is more accurate. The reason why it's more accurate is because we record the revenue and expenses when it's earned or when it's incurred. Okay, what do I mean by that? Revenue is recorded when products or services are delivered to the customer. That's when we recognize revenue. That's part of the revenue recognition principle that we learned about in the previous chapters. Okay, we recognize revenue when it's earned. Otherwise, it's recorded as unearned revenue under accrual-based accounting. Recognize it when it's earned, when we deliver the product or service to the customer. Now, here's the primary difference between accrual-based and cash-based. We also record expenses when they are incurred. Okay, so earlier I gave the example of the electric bill at the restaurant. I received my electric bill. Okay. If I'm a cash-based business, I pay that electric bill and I record it when it's paid. So we're in August, right? So if it's August 31st, I think it's 31st. Yeah. It's August 31st. I received my electric bill and it shows the electric I consumed back in July. Okay? If I'm a cash-based business, I got it in August, I pay it in August, it goes in August expenses. That's cash-based. If I received the bill in August and it was for electric that I used in July, I record that expense for the month of July using an adjusting entry. Okay. I received the bill in August, but the electric was consumed for the month of July. So I will write an adjusting entry, and I will date it July 31st, electric expense, and then accounts payable for the bill, okay, that I received in August. And then later on, I'll pay the bill. In other words, accrual based accounting, we recognize things when they happen, okay, not when it's paid, when it happens. Does that make sense?
Yes.
Great. My microphone is still clear, right? I'm not going in and out and all that fun stuff.
Yes, you're
No,
fine.
it's still fine.
Great, great. Oh, I'm so happy about that. We got that problem.
Dr. Schweitzer?
Yes, Nassim.
Okay, so in another example, if I were to, let's say if I were a tutor, correct?
Okay.
If I tutor someone this month and I receive the money in March of 2022, on a cash basis, I would put it when I got it, which is 2022 March.
That's
On
correct.
accrual, I'd credit it to September when I actually did it.
That is correct. Yep, 100% right. Yep. So that's why accrual.
So that would affect. Wouldn't that affect as you're going back to like a quarter report versus a uh, a semi-annual? Because this may be going into another quarter or another time period, correct?
Yes. The answer is yes, 100%. So, in other words, Nassim, and I'm going to walk through this with you. Okay. So you did some tutoring for next, this month. The student pays you next year. If you're using cash-based accounting, you recognize the revenue next year. Okay. If you're using accrual,
Because that's when I got it. Right.
Yep. If you're using accrual-based accounting, you recognize the sale of the service this month, and the sale will stay in this month, in this year. Because remember, the sale, at the time of the sale, it doesn't matter when you receive the cash. It's when you delivered the good or the service. That's when we record the sale. So here's the difference between the two now, Nassim. So when we look at your financial statements, okay, in 2022, if you're using cash, your sales will be higher than what it should have been. If you're using accrual based, your sales will be the same. Okay. In other words, there will be a difference in the reporting if you're using one or the other. So if you're using cash, it only happens at the time cash is being received. If you're using accrual, we record it at the time of the sale, regardless of what happens with the cash. So to answer your question,
Okay.
yes, there will be a reporting difference.
So my last question, at least for this one, is maybe again I didn't pre-read for chapter 3 or look ahead, and you may be going over this, but could you for let's say myself and my business, like separate in the accounting equation revenues received versus revenues rendered?
Revenues received, revenues rendered. Tell me what you mean by that.
So, in other words, I would separate it. In other words, if I provided a service, I would credit. In other words, they haven't paid yet. I would debit accounts receivable, and I would credit revenues rendered. Now, if someone paid me in cash, I would debit cash, and I would credit revenue, like pure revenue. Like, could I just separate out the revenue column into an actual do you know what I'm saying?
You could,
Like an accrual versus a cash revenue?
You could, but the question is why? Because it's not going to make a damn bit of difference when you go to file your taxes. It's not going to make a damn bit of difference when you even run your report. It still shows up as revenue. It's just how you categorize it. That's the only difference here.
Okay.
Yeah, good question.
Thank you for that.
And sometimes, for business purposes, sometimes it's good to see that type of information, and that's why you might do it. So, it's up to you. Because the reality is it's still categorized the same, right? It's still revenue. Revenue is still revenue. It doesn't matter what you call it.
Well, the only thing I'm worried about, and this may be coming up in a future chapter, is if I tutored someone and I put it under revenue, then I feel like, oh, look at me, I'm making this money. If that person stiffs me and I never get that money, and that person leaves to like Malaysia, I know, which sucks because I never get that money then.
Yep, and but
so I put it under revenue, but it's not cash.
So then you'll make an adjusting entry and write it off at the end of the year. And we'll go over that process. So if you don't get paid,
okay, I'm getting ahead of myself. I'm so sorry, class. I'm so sorry.
You're okay. It's good discussion. I love this type of stuff.
I'm about to say, no, you're fine. You asking some good questions.
Exactly. Mark, go ahead. Did you have a question from earlier? Apologize.
Well, what my question was off of what he said was, I just thought about when a business takes into an account. So let's say, for instance, you're the FedEx or UPS.
Sure.
They take money in constantly because they deal with packages and customers.
Sure.
So to help me understand it is when a business takes in money, that's revenue for them. Is that right?
Yeah. So anytime that there's a sale made, So Mark, let's walk through that example because that's a really good question. So okay, so let's say you're UPS, you're FedEx, that's your business, okay? Um, let's say the customer is going to ship something with your company, all right? What they'll do is they'll place the order for your company to come pick up the package and deliver it to another person or to whatever. At the point of the order, okay, uh, it's unearned revenue. When the customer pays you the cash and you come and pick up the package, then it becomes revenue. That's revenue at that point.
Okay, now I understand. So basically, what you're saying is, I'm sorry, class, please forgive me.
It's okay.
So what you're saying is the UPS store, I'm the UPS store or FedEx.
Mhm.
The person is shipping a package. It's going from here to Jamaica,
Okay.
and the person has used their credit card.
Mhm.
So when we go to take the money from that account, that would be considered
Cash. It's still cash.
cash,
Yep.
cash revenue for the business, correct?
For the business, that's correct. Yep. Absolutely. 100%.
Okay. Okay.
Yep.
Now I'm starting.
Cool. Awesome. Great. No, good questions. Very good questions. Okay, so let's look at a little bit more of the difference between accrual versus cash-based accounting. So we gave the example of the electric bill, right? I received my electric bill in August. It was for July. And so I would date it for July, right, in the adjusting entering process to allocate that expense in the month of July when it happened, right? That's part of the matching principle that we learned about in the first two chapters. Let's look at the consumption of insurance. One of the examples we talked about last week was prepaid account, right? As you recall, a prepaid account is an asset account. We are prepaying an expense. A prepaid expense is an asset to the business because we have not yet consumed the expense. And the business has the right to that asset by canceling the insurance policy and receiving the cash in exchange for the cancellation. Therefore, it's an asset. Okay, so let's look at this example. At the end of 2019, uh, I, okay, yep. At the beginning of 2019, I prepaid insurance for 24 months. That's 2 years. Okay. I prepaid insurance for 2 years in the amount of $2,400. I'm prepaying and that amount covers 2 years worth of insurance. And we started on December 1st, 2019. How do we consume that? Okay, this is where the adjusting entries come into play. If it's cash-based accounting, I simply record $2,400 expense to insurance in December 2019. That's cash-based accounting. Cash-based accounting, $2,400 expense. So it'll be insurance expense, debit, credit, cash to reduce the cash. And that would be recorded in December 2019. That's cash-based accounting. Okay. And we would not, there's no real adjusting going on there. Okay. That's cash-based accounting. That's the reason why we want to use accrual-based accounting is because it's more accurate. So here's how that accrual-based works. We prepay $2,400 of insurance on December 1, 2019. So we debit prepaid insurance on December 1, 2019. Debit prepaid insurance, $2,400. We credit cash, $2,400 because we're paying the insurance company for 2 years worth of insurance. At the end of December, so December 31, 2019, I would make an adjusting entry to represent the consumption of the insurance for that month. So December 31, 2019, I would debit insurance expense, which is on the income statement, and I would credit prepaid insurance, it's on the balance sheet, to reduce the prepaid insurance. So what that does is I'm debiting an expense to increase the expense. That's how we recognize expenses, by increasing them. Debit the expense of insurance, $100, to increase the insurance expense for the month of December. And I would credit prepaid insurance to reduce prepaid insurance account, which is an asset account, by the $100. What that journal entry does, it's called an adjusting entry. What that journal entry does is it represents the consumption of that insurance for that month of December. And then I would do the same exact journal entry at the end of every single month for the remaining 23 months until prepaid insurance reaches a balance of 0. That's how adjusting entries work, and that is how we represent the consumption of a prepaid account. Does that make sense?
Yeah,
Yeah.
this is an example of a deferred expense, right?
Yes. Yep.
Okay.
Deferred expense is a prepaid expense, which is an asset account. Very good. Great questions. Wonderful. Okay. So accrual-based accounting, we write that check to the insurance company first day of December 2019, and we accrue it. You know, accrual is basically saying we're consuming it, right? So we are recognizing a $100 insurance expense every month for the 24-month period. With respect to cash-based accounting, it's simply we're paying the cash, $2,400 for a 2-year insurance policy, so we only recognize the expense in the month of December 2019 when we're paying for that policy. So, Nassim, your earlier question, you had given the question, well, what does that do to my reporting, right? So here's the difference, Nassim. Looking at it from an expense side, you do the same thing with cash from the receipt side as well. But we can see that we're spreading that expense over each year for that 24 months, right? So 2019, $100, $1,200 for 2020, and $1,100 for 2021 to equal your 2,400 total. Now, if we were to simply use cash-based accounting, $2,400 in December and $0 for the rest of the time. So what that does to your reporting is all of a sudden December looks like you went and spent a whole ton of money, in the expense, which ultimately reduces your net income for that year, right? It reduces your net income for 2019 because you have this huge expense recorded on December 1. And so there's your big difference when reporting is you either have $100 a month expense for 2 years, or you have a huge expense in the month of December for 2019. And so when you're comparing cash to accrual-based accounting, you'll have these huge expenses for cash-based, whereas you'll have small expenses on accrual-based over the time of consumption. So that's why it's more accurate to use accrual-based accounting than it is cash-based accounting. That was a fun example. I really like that one. And of course, a lot of great discussions. So revenue. Okay, so revenue recognition, as you know, with respect to accrual-based accounting, is we recognize revenue at the time the goods or services are provided to the customer. Okay, so for example, let's say we have a lawn mowing service business. Okay, we mow lawns. That's our business. If I get a new customer, the customer pays me up front for the season, okay? And I'll mow their lawn, 8 times during the season. And so they'll pay me all of that up front at the time that I sign them up for the service. That is unearned revenue when they give you all the money up front. The reason why it's unearned is because you have not provided the service. When you provide the service, it becomes earned revenue. Okay, that's the primary difference between that. So, using the accrual-based accounting, it's unearned revenue.
Sorry for interrupting.
I'm
so
I'm
sorry.
I'm sorry. Go ahead.
Okay. So I think this goes back to what Nassim was saying before. That does mean that the revenue accounts are already separated. Like there's like a revenue account in the equity side, and then there's the unearned revenue in the liability side.
That's correct. Yeah.
Okay, cool.
But Nassim's question was a little bit different because uh, his question was in regard to if you're using cash or accrual based accounting on when you would actually record that revenue. So that's, and also his question was a little bit more different. Whereas if a customer doesn't pay him, then what happens, right?
Right.
So that's a little different. But yeah, you're on the right track. So unearned revenue is a liability account. Earned revenue is an equity account.
So in
Equity.
regards,
Mhm.
so in regards of a customer not paying, which account there would like the company or business or whoever's providing the service would know that there's a certain amount that the customer hasn't paid because there would be a balance in some account,
That's right.
right?
There will be a balance in accounts receivable with that customer's name on it.
Okay. Balance in accounts receivable. All right.
Yeah, because so anytime you send a bill to a customer, it generates an accounts receivable. And so if that bill goes unpaid, that accounts receivable balance remains there. And then what'll happen is, so with Nassim's example, he had a tutor business. His client didn't pay him last month, and let's say the whole year goes by and Nassim doesn't get paid by the customer. What'll happen is we'll make an adjusting entry at the end of the year to write off that bad debt, and there's a process for it, but we'll walk you through it. So that way Nassim doesn't have to pay the tax on cash he never received.
Okay. And you said we'll cover that?
Yeah, we'll talk about writing off bad debts. Absolutely.
Okay, cool.
Yep. Question. Mark, go ahead.
No, you're fine. I didn't have no question.
Oh, okay. Okay, great. I saw you unmuted. I was just kind of curious. Thank you so much. Okay, so revenue recognition under the accrual-based accounting system, we recognize revenue at the time the good or the service is provided. Under cash-based accounting, we recognize revenue at the time cash is received. That's the difference between the two. With respect to recognizing expenses, under accrual-based accounting, we recognize expenses at the time they happen. Okay, so what does that mean? I received my electric bill at the end of August and it was for the month of July. I would record that expense for the month of July using an adjusting entry because I need to match the expense with the revenue. That's called the revenue recognition principle, or it's called the matching principle. Sorry. So we match revenues with expenses when they happen for during the month that they happened, right? And the way to do that is through an adjusting entry. We're going to talk about that. It's all about adjusting entries. So how do adjusting entries happen? Where do they come from? What do they mean? Right? So adjusting entries happen for four primary reasons. First is deferral of expenses. Deferral of expenses, and this is what I think Tyler brought it up. So Tyler, what you had said with the prepaid insurance.
Yes.
You said that it's a deferral, right?
Yes.
Yeah, so you're 100% right. So a prepaid account, which is an asset account for the business, is a deferral of the expense. We recognize that expense when the expense is consumed or when it happens, right? And so under the accrual-based accounting system, what we would do is uh, we debit prepaid insurance and we credit cash when we when we prepay the insurance. At the end of each month, we would record an adjusting entry to represent the consumption of that expense. So therefore, it's no longer deferred. It becomes an expense when it's no longer deferred. So the way to do that is at the end of each month, we would debit insurance expense and credit prepaid insurance. Does that make sense?
Yeah, that makes sense.
Cool.
But and it's the same on the flip side, right? Like, would the
Yep.
whole unearned revenue thing be deferral of revenue?
Yeah, 100%. Yeah, that's correct.
Okay.
So deferral of revenue is the second one here. So deferral of revenue simply means that we have not yet provided the good or the service to the customer, and the customer already paid us. That is unearned revenue, would be the account that we would use for deferral of revenue. Deferral simply means that we recognize it when it happens. We recognize it later. Okay. Deferral means later. So, looking at deferral of revenue, we would use unearned revenue. Earlier example I gave is I have a lawn mowing service business. Customer prepaid me, the business, for 8 services in advance. So what that means is uh, I would, what am I trying to say here? I would, what am I debiting? Oh, I'm debiting cash. I'm debiting cash to increase my cash, and I'm crediting unearned revenue. That would be the entry I would make when a customer prepays me, right before I mow the lawn. Nasim, yes, you're correct. So the earlier example under deferral of expense, we're moving an asset to an expense. That's correct. Throughout the time that it's being consumed with each adjusting entry. Yes. Uh, so with respect to deferral of revenue, the customer prepaid us before we provide the service to the customer. That is unearned revenue. It becomes earned when we start mowing the lawn. So what that means is we would when we receive the cash from our customer before we mow the lawns is we debit cash, credit unearned revenue. That's deferral of revenue. Then at the end of each month, as I'm mowing the customer's lawn, I'm going to recognize that revenue. The way to do that is with an adjusting entry. At the end of the month, the adjusting entry will be um, a debit to unearned revenue and a credit to revenue. Okay, that represents the consumption or the earning of that revenue. Does that make sense?
Wait. Okay. So when it first happens, like when a customer pays me for a service I haven't provided yet, I would debit cash, credit unearned revenue, and then as I'm providing the service, I would debit unearned revenue and then credit revenue.
That's correct. Yep.
Okay.
The record of debiting unearned revenue, we're reducing unearned revenue and we're crediting revenue to increase revenue. And that's representing the when we're earning the revenue. Yeah. But yeah, that's the adjusting entry that we'd make. That's correct.
Okay.
Great question. Okay. So accrued expense. Accrued expense. Accrued expense. Okay, so deferrals is we prepaid it or we got prepaid. Okay. Accrual of the expense. Accrual of an expense, an example that I can give you is wages. Wages is a perfect example. I have an employee. The employee works for my lawn care business. The employee works 2 weeks, and then I pay the employee at the end of the following week for the 2 weeks that the employee worked, right? That's called an accrued expense. So, for example, let's say you work 40 hours a week, you're a full-time employee. You work 40 hours a week. You don't get paid every day. They're not paying you cash at the end of every day that you work, okay? That doesn't work that way. In almost everywhere I've ever worked, and I'm sure this is the same for most of you, you get paid every 2 weeks. Sometimes every week, but most cases every 2 weeks. Okay. So 2 weeks goes by. My full-time employee worked a total of 80 hours. 40 hours in the first week, 40 hours in the second week. That's 80 hours. The employee work the 80 hours. They make $10 an hour, so it's $400 a week. That's $800 total that I owe the employee. I haven't paid the employee yet. But what I've done over that 2 weeks is I've accrued the expense. So every day the employee worked, every hour the employee worked, I'm accruing that expense, right? As I've accrued the expense, I now have to pay my employee. So here's how it works, okay? So the first thing we do is we need to recognize the accrual of that expense. So at the end
Wait,
of,
quick question.
go ahead, Tyler.
Okay, so I don't know if I might be jumping the gun, but would you only record in terms of wages, record or adjust for accrual when the 2 weeks that they're earning money like overlaps 2 months?
Oh, yeah. So great question. So at the end of so basically what Tyler's asking is, let's say I have an employee who's working this week and next week. Today's the end of the month, by the way. So what I would do is I would actually record that accrual at the end of that month. So Tyler, to answer your question is, yesterday was the 30th, today's the 31st. I would accrue only 2 days of that employee's wages for the month of August. And then I would accrue the rest of it for the month of September, because that goes along the lines of the matching principle.
So would it be two different recordings, one for August and then one for September?
Yes. Yep.
Okay.
That's correct.
Okay.
Yes, this
I have a
also
question.
Go ahead, Marina.
I also wanted to give the also the example, for example, if there's like a fiscal year, for me, fiscal year ends in June, begins in July.
Mhm.
For the end of the month, like there has to be two different payroll entries because of the way that it will like separate the fiscal year. So we have to record a portion in June and a portion in July to make the amounts match.
Yeah, that's 100% right. Yeah, and that's very common. And
Okay, so that was an example of an accrued expense, right, Marina?
yeah, that's correct.
Yes,
Okay,
yes.
okay. All right, cool. Just making sure.
Yeah, excellent example. And yes, that's 100% right. So to answer your question, yes, we would accrue it based off of the month that they are earned in.
Okay,
I guess,
I have a
okay.
question.
Oh, I'm sorry. So just to sum it all up, you wouldn't like make an adjustment, for example, if within 2 weeks that I'm paying an employee, it all happens within the same month? Or how would that be? Would I just report that like within the month?
Yeah, so basically you divide the days apart. So like for example, if the employee is working this week and next week, 2 days of this week would go into the month of August. The rest of it would go into September.
Right. Okay. Yeah, I'm pretty sure I understand. Just asking
Cool.
questions.
Go ahead, Mark.
So basically, my question is, okay, Tyler, when basically what professor is basically trying to say is you working 2 weeks. What happens is when the person you work your first week, you're basically working 2 weeks in a whole.
Mm-hmm.
I've worked a job where you have to the fiscal year ends for me in October.
Right.
So we're doing what they do is they basically it's an accrued expense. So you work a whole month, a whole year when the fiscal budget ends in October. Well, the fiscal budget ends at the end of September. The new fiscal year starts in October.
Right.
So basically, how they break it down is you work a full 80 hours every 2 weeks. That the money that you already accrued for the month, that'll be on your first check. Then you work another 80 hours will go on your next week's paycheck. If that
That's
makes
correct. That's correct. Yep. Yep. And that's common across government agencies. It's the same way here at UDC. So it works the same exact way that Mark just described it. Yeah, and that's more government accounting, but it works the same exact way. That's right.
Would that be an example of annual reporting though, or monthly?
Hold on
On
just a
that
second.
Mark just gave.
Uh, let's get Jenny first, and then we'll come back to you, Tyler.
Um, so I'm so sorry, but
That's all right.
straight to the point. So how would you put that in the like as if like debit?
Sure.
Okay.
Yeah. Yeah. Great question.
Mm-hmm.
So here's how it works, Jenny. Is for the accrual. Okay, let's do it for the accrual first. And actually, I was just about to get to that part. So the way it works for wages is the employee works the 80 hours. Let's say it's $10 an hour, so $800, right, for the 2 weeks worked. If it's during the same, let's say it's in the same accounting period, so it's for the month of August. Employee worked the past 2 weeks, 80 hours, month of August. I would I would debit wage expense to
Mm-hmm.
increase the expense and credit wages payable. Debit wage expense, credit wages payable. What that does is it recognizes the accrual of the expense. So I'm increasing the expense and I'm increasing the wages payable.
Gotcha. Thank you so
You're
much.
so welcome. That's an excellent question. And then when I get ready to pay my employee, which doesn't matter when that is, but well, I mean, it does. When I get ready to pay my employee that following week, I would debit wages payable to reduce payable and credit cash to reduce my cash. Excellent question. Excellent question. Tyler, go ahead.
Um. Okay, go over that last half. So you're paying your employee. You said you would debit wages payable and credit cash.
When I'm paying them, yes,
Right. Okay. So when you credit wages payable initially, you're crediting wages payable
to increase it.
for the
The
80
accrual.
hours that they worked.
Yes, that's correct. And that whatever's going on their paycheck is what it gets.
Oh, okay. Never mind. All right. So that makes sense. It's a different thing because it's per paycheck. All right. That makes sense. Okay.
Good question.
Like how you said before, Professor, debit equals credit.
That's
So
right.
basically, you're just trying to balance out the statements.
Yeah, exactly. That's exactly right. Yep. Yeah. Excellent points. Very good. Excellent questions. So happy. Okay, and then accrued revenue. Accrued revenue. Example of this. Let's say I have a customer that makes multiple purchases throughout the month. Okay. Uh, that would be a form of accrued revenue. I'm earning the revenue over time. Um, We'll go through a couple of more examples of accrued revenue. That one gets, I mean, it's not really tricky. It works the same way as an accrued expense does. It's just how we recognize that revenue when it happens. Uh, so, employee works 40. Yeah, yep. So Mark, exactly. So with respect to payroll really is it's broken out by how much the employee works per week. And then it also depends on how frequently they're paid, and that's how many times we make the accrual entries. Good question. Excellent points. Very cool. Very cool. Yeah, payroll accounting. It's a whole class in itself. To be honest, there's a lot of different aspects of it because then there's a whole chapter on it actually in our textbook, and I think it comes a little bit later. But with payroll accounting, there's also tax withholdings and benefits and things like that. I think it's like chapter 12 thereabouts. So we'll get deeper into it. Okay, so this goes through exactly what we were just talking about. So prepaid insurance, prepaid anything. As you know, prepaid is an asset account. So as we're accruing it or as it's being transferred at the end of each month through the adjusting entering process, we're decreasing the asset and increasing the expense to recognize it. So as I mentioned with prepaid insurance, we debit prepaid insurance credit cash at the time we're prepaying it. At the end of each month to represent the adjusting entry, we debit the expense to increase the expense, and we credit the prepaid insurance to reduce the prepaid insurance. And it works the same exact way with any type of accrued, deferred expense. Okay, so here's another example following the steps. Prepaid insurance, the 2400 that we talked about earlier. So the first transaction is we would debit prepaid insurance and credit cash to reduce our cash. That's the first transaction. At the end of each month, we would debit insurance expense $100 and credit our prepaid insurance $100 to reduce our prepaid insurance account. And we would do that at the end of every single month for 24 months.
Hey, Professor, quick question.
Yeah, go ahead, Tyler.
So in terms of applying this to real life, would I so I'm trying to, you were talking about accrue, I think, I want to say revenue.
Yes, thank you.
So so let's do the flip side of the wages thing. As an employee and as a student, as both,
Mhm.
would I need to know or know like payroll accounting? Would I be able to account for myself like the wages that I've accrued and this, that, and the third?
Yes. Yep. So Tyler, excellent question. So and we'll get deeper on that in chapter 12. So in like 4 more weeks. But to give you an idea of what that looks like is at the end of every year, you receive your W-2 statement. Your W-2 is what you use to file your taxes with, right?
Yes.
And that represents all of your accruals over time for your
Oh,
wages. Yeah, that's
so
how
like that is my
they
accounting
calculate
point.
it. That's how they calculate it. Yeah. So it represents all of your time worked. It'll show your gross wages. It'll show your total taxes you've paid. It'll show your total deductions, things like that, right? That's on the W-2. And so at the end of every single year, you receive your W-2. It's usually like the beginning of the following year, right? And that shows you the accrual. That represents everything that has happened with respect to your paychecks throughout the year.
All right, so that's pretty much like my side, the flip side, like the
Yeah,
accrued
your
revenue
side is the
side.
W-2, exactly.
All right, perfect.
Yeah,
Cool.
cool. Yeah, absolutely. So on your balance sheet, as you know, prepaid insurance is an asset account. That prepaid, all prepaids decrease over time until it reaches a balance of zero. At the end of every single month, we would reduce that prepaid insurance by $100 to represent the expense on the income statement. And that'll eventually reach zero at the end of the 24 months. At the end of the year, so let's take a look at the end of the year. Well, this is the end of the first year. We started in December, so it's only $100. But the balance on the balance sheet for prepaid insurance would be $2,300, and your insurance expense would have a balance of $100. And this is the journal entry that we make: debit insurance expense, credit prepaid insurance. It's everything I already told you about, but I've been doing this for a long time, so I've memorized so much of this stuff. And not from these examples, but it's from so many years of practice. As I said earlier, accounting is a practice, and the more that you practice it, the more you will remember everything. That's very true. Okay, so let's take a look at another example. In this case, we're adjusting for supplies. So think about, let's say you have a business and you need to purchase raw materials in order to create a product, right? You're a manufacturer of sorts, and you need to purchase raw materials. So in our business, we purchased $9,720 of raw materials in the month of December. We created some of our finished goods in the month of December. So we need to account for the amount of supplies used and unused. So 97,200 was purchased. We used, how much did we use here? Like $800 worth, thereabouts?
1,050, I think.
Is it 1,050?
Yeah.
Oh yeah, you're right. Yep. So we used $1,050 worth of raw materials in the month of December. So at the beginning of December, we purchased our supplies. So debit supplies, 9,720. Supplies, as you know, is an asset account. And we would credit cash, 9,720, to represent the purchase at the beginning of December. We used $1,050 of supplies during the month of December. So we would debit supplies expense at the end of December. So December 31, debit supplies expense, $1,050 to represent the expense. And we would credit supplies, $1,050 to reduce our supplies. And at the end of December, we're left with $8,670 on our balance sheet for supplies. There's so many different examples, but the concepts are always going to be the same. Earlier we talked about T accounts. As you remember, a T account has the name of the account on the top, the account number. And this basically all it does is it's a visual representation of increases and decreases to our accounts, right? And this just kind of shows you what that looks like from a visual perspective. Oh, depreciation. Okay, so this is a newer concept for most of you. Depreciation. Depreciation represents the loss of usefulness over time for an asset. Loss of usefulness over time for an asset. That's the concept of depreciation. Assets like property, plant, and equipment depreciate over time. What do I mean by that? Well, a building, let's say you have a warehouse. That warehouse will start to fall apart as the years go by, right? If you don't fix it, it falls apart. That's what buildings do. Same with your house, same with your car, same with your, right? Things fall apart over time if you don't take care of them. That's normal. That's called day-to-day wear and tear. Okay? How do we recognize wear and tear, which is the less usefulness over time. It's a loss of usefulness over time. We call it the loss of useful life over time. We do it through this process called depreciation. Equipment, buildings, cars, they depreciate over time. They lose value over time. That's normal. That's what's supposed to happen. And so to represent that loss of usefulness over time, we account for it through this process called depreciation. Now, depreciation, there's several different ways to calculate depreciation. And I'm going to show, this first one is the simplest way to calculate depreciation. We take, it's called straight line. What straight line means is we are depreciating the asset the same amount over the useful life of the asset. Let's first talk about useful life. The IRS, who I do not like, the IRS tells us how long something should last in terms of accounting. Okay, we know that, for example, a car, a dump truck. Let's say we own a. This is my favorite example. I love this example. Let's say we own a construction business, and in our construction business, we have a dump truck. The dump truck is our equipment, right? That dump truck cost me $25,000. That's the asset cost. Cost me $25,000. Okay. According to the IRS, the dump truck with a value of $25,000 should last 5 years. Okay, it should last the business 5 years. We know it's probably longer than that, but IRS is 5 years. Okay, so useful life 5 years. The asset cost is $25,000. That's the purchase price, yep, of the asset, $25,000 minus residual value. Residual value is also called salvage value or scrap value. Residual value or salvage value or scrap value represents what the asset is worth at the end of its useful life. In our example, it's 0. It's worth nothing at the end of the 5 years. So 25,000 minus 0 divided by 5 years is $5,000 per year of depreciation for a total of 5 years. So $5,000 would be my depreciation expense each year for 5 years. Now remember, the concept of depreciation means we're losing value over time of our asset because it's losing its useful life. So let's break down a little bit more, even further. Useful life. How long things are expected to last. That's useful life. It's based off of wear and tear. Over time, things lose their usefulness, or they become outdated or obsolete, or a result of wear and tear. That's useful life. How long it's supposed to last. And that's always given to us typically through the IRS. Salvage value.
I have a question.
Yes, please.
So, like, useful life, like, what units would it be? Would it be like years, days, months?
Years. It's typically always measured in years.
Gotcha.
There's some instances where it might be measured in hours. Like, for example, if it's a piece of machinery that measures time in hours used instead of miles driven, that might be part of useful life. But for the most part, it's always years. Good question. And we'll talk about that. We'll talk about all of that in a lot deeper detail soon. Salvage value. Salvage value is what is it worth at the end of its useful life? How much can I sell it for? What's the market value? What's the scrap value? What's the residual value? That's all salvage value. What is it worth at the end of its useful life? Here's another example. This one's pretty good too. Let's say it's a forklift. So our company has a forklift that we purchased for $26,000. And we put it into service on December 1st. Why are we always doing stuff at the end of the year? I don't know. Okay, December 1st, I purchased a forklift, $26,000. It has a useful life of 5 years. The equipment also has a scrap value of $8,000. The question is, what is my depreciation using straight line? Okay, so it's easy to figure out. We have $26,000 minus $8,000 divided by 5 years. That gets me my depreciation expense per year. Then we divide that per year divided by 12. That's the easiest way to do it. Another way of doing it is dividing the total, right? So 26,000 minus 8,000 is 18,000. So original cost minus salvage value equals net cost. So 18,000 divided by 5 years. Divided by 5 years will get you your annual amount, or you can divide it by 60. 60 represents 60 months in 5 years. So 12 times 5 is 60, right? So 18,000 divided by 60 months equals $300 per month. So that first month, since I put the equipment into service in December 1st, month of December would be 300, and then the rest of it would be per year. So to record depreciation, very simple. It works the same exact way as every other adjusting journal entry. We debit depreciation expense and we credit accumulated depreciation. This is a new account. You probably haven't heard this one before. Accumulated depreciation is an asset account. Okay. Why is it an asset account? Good question. I'm glad you asked. So, equipment. We have a dump truck. We purchased it for $26,000. We debit equipment and credit cash. That was our first transaction when we bought the forklift. Yeah. Bought the forklift, $26,000. Debit equipment, credit cash, forklift. We depreciate the forklift over time. To represent the depreciation expense at the end of each month or the end of each year, whichever, we debit depreciation expense and credit accumulated depreciation. Accumulated depreciation is a different account. Okay, it's an asset account, but accumulated depreciation holds a credit balance. What this does is it reduces the value of the equipment over time without affecting the total value of the equipment. What that means is instead of reducing equipment, which you would never do, this is like the contra account to equipment. It represents the decrease in value over time. That's what accumulated depreciation is.
So,
Okay.
Professor, question.
Please go
So,
ahead.
so basically, the accumulated depreciation account is basically like keeping track of whatever the depreciation is for that item, right?
That's correct. Yep.
Okay.
And you do that for each piece of equipment or building that you have. Yeah.
Okay.
Yeah. Excellent question. Go ahead, Tyler.
So, crediting accumulated, oh, that is just a mouthful. Crediting accumulated depreciation is pretty much crediting equipment, but you would just not credit equipment.
Exactly. That's exactly right. Yep. And the reason why we don't credit equipment is because at the end of the useful life of the asset, we need to take it off of our books. Okay. So what that means is we'll increase accumulated depreciation by crediting accumulated depreciation, which is an asset account, up to the value of the equipment. So once accumulated depreciation reaches 26,000, you have equipment debit 26,000, accumulated depreciation 26,000. That represents the value reaching zero at the end of its useful life. And so what we would do is at the end of its useful life, we would actually reverse the entry to remove it from our books. But that won't happen until the end of year 5. Marina, yes, it's just like a tractor. A tractor is equipment. Absolutely. Okay, adjusting entry for depreciation. So we debit depreciation expense, credit accumulated depreciation. We do that at the end of each month or the end of each year, depending on that, where you are when you put it into service. So on our balance sheet, it would look like this. We have debit equipment for the value of the equipment. Accumulated depreciation shows up as a credit asset account, which in turn looks like a reduction of equipment. And so your debit side minus your credit side gives you 25,100 would be the difference between so it's basically equipment minus accumulated depreciation would be the balance for that asset.
Professor, I have a
Yes,
question.
Marina. Yes.
So going back to the what was it, the salvage?
Salvage value? Yeah.
Yeah. How would we like calculate that part, or is there like something that we need to look into?
Yeah. No, great question. So salvage value is determined by the market value based off of the condition of the equipment. So at the end of year 5, what would the equipment be worth? Right? That's what
Right.
salvage value represents. Or what can I sell it for? That's what it would represent.
So where will we get that value? Like,
Yeah,
is there like a certain website we have to go to or something? Or
yeah,
is it like,
kellybluebook.com.
okay.
For a car, right? It's industry specific. Yeah. So you would basically look up what that value was based off of like the hours used or the miles driven or the wear and tear. Right. That's salvage value.
Okay, so like for example, if it's like for, I don't know, like computer equipment, I would go to like a Microsoft website. They have a salvage value there of that certain
Yeah, you
item,
could
and
look it
then
up by that. Mm-hmm.
okay, okay.
Yeah. Yeah, that's how it's typically determined. It's a very industry specific. Good question.
Is there I'm sorry for
Go ahead.
interrupting, but is there a record of like all the types of products that have their salvage value recorded?
That's a good question. I don't know. I really don't know the answer to that question. I don't know if like everything would be in one place like that.
Like if there's like an index or something like that.
Yeah, it's possible.
Get to that.
The IRS might track that data. I'm not too sure, to be honest. I'm sure it's probably tracked somewhere, but I don't know if everything would be in one place. It's probably organized by industry.
Okay.
So it's kind of like how cars are like the value of the salvage value of a car that would show up on like Kelley Blue Book, or NADA. Those are industry specific publications that tell you what the value is.
Okay.
So yeah, it's probably by industry. Good question. Great question. It'd be kind of cool to find out though. Okay, deferral of revenue. So, and we talked about this already. An example of this would be a customer prepaid us. So that's unearned revenue. Over time, we mow the lawn, right? So we earn the revenue. So when the customer first paid us, we debit cash, increase cash, credit unearned revenue to increase unearned revenue, right? Now, over time, we are going to earn that revenue. So at the end of each lawn service, I would debit unearned revenue to reduce the unearned revenue and credit revenue to increase revenue. That's what this shows us. And here's an example of that. This example is a little bit more cumbersome, but what you need to know is when we actually earn the revenue, we debit unearned revenue and credit revenue. That's the important part. So when we first receive the cash from the customer, debit cash, credit unearned revenue. Then when we earn the revenue, we debit unearned revenue and credit revenue. That's what this second transaction shows us, the $250. And you do that with the performance of each at the end of each service, right? It's the same exact process that we talked about with the lawn business. Okay, so let's take a look at oh yeah, that adjusting entry. So debit unearned revenue, credit revenue for the 250 that we earned. What about accrued expenses? So the earlier example I gave you was the payroll, the wages. So at the beginning we would debit wage expense and credit wages payable. Right. So here's an example, and guess what? It's wages. So we would debit our wage expense, credit wages payable, and then when we go to pay our employee, we debit wages payable, credit cash. So debit wage expense, credit wages payable. Salaries, wages is all the same, right? Salaries or wages. It's just all basically just names, right? But salaries or wages, wage expense, wages payable. And then as you pay your employee, we would debit wages payable, credit cash when you pay your employee. Future payment of an accrued expense. So in this example, and this goes back to what we were talking about, what if the employee worked a few days in 1 month and then the rest of the time in the next month, right? And that's what this example shows us. So we would debit salaries payable for the few days that an employee worked at the end of December, right? And for January, we would debit the expense for those few days the employee worked in the month of January. And then we would credit cash when we pay the employee. Yeah, it's very typical, very, very typical type of example. What about accrued revenue? So let's take a look at this example. So we have a customer that is agreed to pay us for the next year for future services. So it's very, very similar to how do I want to say this? Think of like a contract. So let's say we have our lawn service. The customer says, "Hey, you know what? I like your lawn service so good. I'd like to contract you to provide the services for next year." So great, that's wonderful. So at the time the contract is made, we would debit accounts receivable for that customer because they're not paying us in cash up front. I mean, sometimes they are, but that would actually be unearned. But since this is accrued revenue, customers contracting with us, so we debit accounts receivable for that customer and we credit consulting revenue. Of course, that's what it looks like visually. Future receipt. So the customer is paying us at the end of what appears to be about a month worth of consulting. So we debit cash, $2,700, credit the accounts receivable balance, and credit consulting revenue. And you already know how they show up on the income statement and balance sheet. So deferrals, accruals show up as assets or liabilities, depending on the type, right? And then when they're incurred, that's when they go to the income statement. This is an example of a trial balance. I think we kind of saw an example of this before, but let's just kind of review what a trial balance is. A trial balance first shows us what our balance is at the end of the year. That's the part that's under the unadjusted trial balance. At the end of the year, we make our adjusting entries. Our adjusting entries are then allocated to each account through the adjusting entry process. And what we do here is we take our unadjusted trial balance plus our adjustments to equal the adjusted trial balance. The adjusted trial balance represents the balance of each account after the adjustments have been made. That's what this tells us. It's just a nice visual representation of that. And I typically wouldn't, the nice thing is that that's usually done through the your accounting software. Usually takes care of all that. Mark, did you have a question? Are you okay?
Yes, I do.
Sure.
On the adjusting trial balance, does C. Taylor, the capital, is that his salary or how is?
Oh no, yeah, good question. So capital is called paid in capital. What that represents is C. Taylor. That's the owner of the business, right? He or she at some point in the past deposited $30,000 into the business, whether that it was through cash or bringing in equipment or whatever into the business. That $30,000 for Taylor paid in capital represents the owner, C. Taylor, the investment that individual made into the business. So that's what the capital account is. And then you'll also see C. Taylor withdrawals. That represents cash withdrawals that the owner is taking out of the business. Does it help to answer your question, Mark?
Yes, it does. And I see how it transferred from unadjusted trial balance over to adjusted trial balance. So basically, if the $200 he took out is being adjusted as well.
No, so good question. So you'll see here that not all accounts are adjusted. The adjusted accounts are only those accounts that have an adjusting entry associated with them. So, for example, the one that you're looking at here, the paid in capital or the withdrawals, there was no adjustment. So, in other words, that was just a standard journal entry that we made. There was no adjusting entry, and that's common for quite a few accounts. Like for example, the cash account. We didn't make any adjustments to cash. We didn't make any adjustments to equipment. We didn't make any adjustments to accounts payable, capital, withdrawals, rental revenue, rent expense, utilities expense. None of those accounts have adjustments that we made to them. So not all accounts will have an adjustment made, but they'll still have a balance. So that balance, if there was no adjustment made, it goes from unadjusted to adjusted with no adjustment made, if that makes sense.
I got you, sir. Thank you.
Cool. You're welcome. Yeah, great question. Great question. Okay, so what are the effects on the financial statements? So with the accounting cycle, we analyze transactions and we make our transactions through journal entries. Then we make adjusting journal entries. We go through the process of verifying those adjusting entries through the trial balance. And then we start the closing process. But before we start the closing process, we prepare our financial statements. As you recall, income statements show revenues and expenses for an accounting period. And After we've made our adjusting entries through the adjusted trial balance, we can see the adjusted income statement. We will do the same process for statement of owner's equity, the balance sheet, and the statement of cash flows. Owner's equity shows you any type of paid in capital minus withdrawals plus your net income. With respect to the balance sheet, it shows assets, liabilities, and equity. And with respect to statement of cash flows, it shows changes in cash for the period. So this just kind of shows us a nice visual representation of how each financial statement is prepared after we've made our adjusting entries. Okay, a couple of quick formulas and then we'll close this chapter out and we'll start our next chapter here shortly, is profit margin. Profit margin, we take net income divided by net sales to find our profit margin. So you might be asking, well, what is net sales? That's also known as your net revenue. Net revenue. Okay, your total revenue. So total revenue is the same as saying net sales. Net income is found at the bottom of your income statement. Income statement shows revenue, total revenue minus total expenses equals net income. Your net income will show up at the bottom of your income statement. To find the profit margin, we take net income divided by net sales. That gives us a percentage, as you would imagine. The percentage tells us how profitable our company is, and that is profit margin, right? And it's a nice ratio to use when understanding how profitable a business is. Net income divided by net sales, both of which are found on your income statement. Okay, and this just kind of recaps what we went through. The initial payment versus cash. On the left side is accrual. On the right side is cash-based accounting. Isn't that nice? Just kind of shows us the difference between the accrual method and the cash method. Same with the revenues. Okay, great. So that is the conclusion of chapter 3. I'm going to stop the recording here, and we will begin chapter 4.